Hello everybody and welcome to my video on STEM. So this is my full analysis of STEM and I want to try to be as objective as possible. There's things I really love about the company and there's things I don't like as much, and then I'll tell you my opinion at the end of the video and my decision with this stock. But first of all, what does the company do? Well, the company does battery storage solutions and sells software that it attaches to its battery solutions. And you can see through this dual combination, they've gotten into different businesses, from energy storage to helping with EV charging, to helping with demand response, bill optimization, virtual grids, microgrids, reselling electricity to utilities. They're essentially one of the key sellers of batteries to both utilities and large companies who need their batteries to save money on their electric bills. And I think they have a lot going for them. So let me just divide the business into two distinct parts. That business as the hardware part, which is a design service, right? They're an engineering service where they install other people's hardware for their clients. And that's where the bulk of the revenues come from. And then they have the Athena business, which is the software business. And that software business helps them earn much higher gross margin for the software business. And this company has been presenting itself as a software company ever since its SPAC, really. It's kind of the Peloton business model, where you sell an expensive bike, you don't make much money on the bike, but then you're going to have recurring revenue for 20 years from people subscribing. Well, Athena has a little bit of the same thing, except it attaches a contract to the hardware that it sells, where it expects to earn 80% gross margin over the long run. But in the meantime, right now, the bulk of the revenue has very, very low gross margin at 10% for front of the meter and between 20 and 40% for behind the meter. But the behind the meter sales are a much longer sales process. So let me just go through the hardware installation business. So what they do is they will assemble battery cells for companies, and then they add a software layer for it. But they will install it both for companies and for utilities. And one of the big advantages with these battery storage systems, which I don't go into this video, but this is essential for the future of the grid, right? As the grid is moving towards renewable energy is intermittent, right? Solar is only out there during the day, and so you need to be able to store the energy at night. Same for wind, even though wind is used to a lesser extent with these battery storage systems. Battery storage systems, however, are so important. They're a way to deal with peaks on the grid. They're a way for companies to save money, to buy energy when it's cheap from the grid and use their own energy when the grid has like a peak pricing. There's so many benefits to batteries. I believe batteries are going to be pervasive. Installing battery is key. And one of the main installers of batteries right now is STEM, and they have Fluence, which is another competitor, but STEM is kind of one of the main ones, along with Tesla. I'll get to Tesla in a second. And one of the big advantages of STEM is that they are battery agnostic, right? They have their own contacts, many of them in China, and they install a lot of Chinese battery packs, which are significantly cheaper than the elephant in the room, which is the Tesla megapack. Per my calculation, Tesla megapacks are about 30% more expensive than the Chinese competition. That's my calculation here. But when you listen to the conference call, it's important to note that they install megapack, and that megapack Tesla is still their number one supplier of battery units. So I believe this is very bullish for Tesla. I believe the success of STEM will lead indirectly to the success of Tesla, because they install Tesla too, and they install the Chinese competition. And of course, on top of that, they had their software, and their software is context agnostic. The two main types of installations are behind the meter. So they sell directly to companies. Like, for example, they could sell to, say, a Walmart or a Home Depot, and that allows them to reduce energy bills. You feed in electricity, say, at night when few people is using it, and then when it's cheap. And when you get peak pricing, say during the day or at 5 p.m., you would use your own store energy. There's also a way to earn a return on investment on your batteries by buying electricity from the grid when it's cheap reselling it to the grid when it's expensive, which is kind of where the software comes in. Also, a lot of corporations like it because it helps with their ESG objective. But of course, the more important aspect is the energy savings. Another important point for behind the meter companies is that as these companies use electric semi-trucks, and there's a lot of Chinese electric semi-trucks as well, actually, that are going to enter the market, they are going to need some of these battery setups, because if you want to charge an electric semi-truck quickly, you need a megawatt charger. You need a charger that's able to dump a whole bunch of electricity really, really quickly in a battery, and you oftentimes can't do that from the grid. You oftentimes need a battery. So a lot of companies are going to have an incentive to adopt behind the meter battery solutions, but keep in mind that gross margin here is very, very small, about 10%. So that's very small gross margin. It's almost like you're running a charity with that kind of gross margin. It's too small, in my view. And then the front of the meter, right, is when you sell directly to utilities, and it helps them increasing the returns on their assets. For example, your solar installation. Say if you have a solar field, if you add a battery that helps you resell that electricity when it's most in need and not necessarily when you're getting it produced because there's a lot of sun out there, it also helps you ramp up your plants and helps you with like peaker plants where you don't have to use a peaker plant anymore. You can just use today a battery and imitate a peaker plant with a battery. So there's a lot of advantages for front of the meter installations, that is for utilities. And another thing that I like, of course, is that right now they're selling a lot of these systems to solar, to solar fields, right? Solar plants. Like we see a lot more fields that utilities are setting up with you'll have tens of thousands of solar panel in a field, and so oftentimes if you add storage to that, it helps you really create a full-fledged power plant that can produce electricity both at night and during the day. Batteries really unlock a lot of value from your solar investments, which for a lot of these companies are already existing. Like there's a lot of solar investments out there that still don't have batteries set up with them. And like I said, the gross margin, depending on your look, depending on the data, depending if you think gap or not, is between 9 and 11%, depending on what I can calculate here. And in 2021, it was 5% gross margin. And by the way, that includes both hardware and software. But that gross margin is so small. Of course, the software has much higher gross margin. The gross margin are trending in the right direction in STEM's defense. But I mean, if we had this current market, like I doubt a company could go public with that type of gross margin because it's very small. But they're trending up, and just like Enphase and Tesla, and that's why the stock was up, by the way, quite a bit in September and October for STEM, because just like for Enphase of Tesla, they're going to benefit from the IRA. A lot of different subsidies are going to come in or are already coming in, helping a lot of grids and a lot of company customers acquire these systems. And so the IRA makes their main product much cheaper. So that's a major tailwind, this IRA coming to STEM. Now, let's move to the software, which a bunch of Wall Street, most of Wall Street is interested in the software. And me, if I were interested in buying in this business, that would be mostly for the software, because software has great margins, 80% margin, recurring margin. You attach a 20-year contract to the battery that you just sold. I just love the software margins, right? And this is where it gets complicated for me, because they claim that their software is ranked number one and that is the best software for what they do. I don't doubt that. But I do believe that even though the Tesla software is a little different, I do know that we don't have the data for Tesla software. And I go into this full video comparing both software, and even though they're not exactly in the same category, could the Tesla software be a substitute for the Athena software? And we don't know how big the Tesla software is. All we know is an interview from the lead engineer working on it back in spring of 2021. That's like all of the data we have on Tesla. So So it's tough for me to make a full comparison between Athena and Tesla, mostly because I lack a lot of data on Tesla and on Tesla software. But I do know that since still today, the majority of the sales of STEM are for Tesla megapacks. In my view, Tesla has the upper hand in selling its software when it sells a megapack, right? Why wouldn't companies just use Tesla services to set up a megapack if they've decided on ordering a megapack? So I don't doubt that it's a major software. I don't doubt that it's ranked number one within its category, but because I don't know enough, I don't know if there are substitute software in slightly parallel categories. And we also have the elephant in the room, right? A major competitor who has not communicated on that, which makes me uneasy, I guess, to say the least. But anyways, there's no doubt it's a great software, and the software is a good software. But like I said, anyways, let me move on. Then there was the issue of the short report. So whenever a stock is down quite a bit, like STEM was, it's when the shocks come, and the short reports just want to kind of kick the man when he's down, if that makes any sense. That's kind of what short reports do. So poor STEM, IPO'd at the peak of the market. Of course, the stock was divided by 4, and then the last thing you have a short report, really the last thing that company needed. I'm going to be objective in analyzing that short report for you. I know some of you have asked in the comments, so let me just go through it. So one of the first point of the comment short report is that STEM finances one of their flagship customer, and revenue financing. I don't like it too much. So to me, it's an orange flag, right? It's a claim, by the way. Keep in mind that we're all biased in this, and Blue Orca, like they say at the beginning of the report, they say they're biased because they're short, and of course, if you own the stock, you're going to be biased because you're long. And I don't own the stock, so I guess I'm the least biased here, you could say. So of course, revenue financing, I don't like it. And if you've seen my prior videos, I give a lot of flack to say GM. Like I don't like that GM, for example, finances its own trucks and its own vehicles with GM financials. But when I attack revenue financing, it's typically within the context of an asset of declining value. Like, for example, let's say Ford finances a Ford Raptor truck, a $90,000 truck, and come 2027, that truck has lost 80% of its value. That's a declining asset that you just financed that doesn't hold its value, and so all of a sudden you're making a huge loss. I think in the case of STEM, because what they're financing is a future forward asset, I think that's just an orange flag and not a red flag, because what's going to be the declining value of that asset? I don't think it's going to be that high, because they are right at the beginning of a mega trend and they're financing a very, very useful money generating product. But nonetheless, revenue financing is not ideal, and so they claim that this happens at STEM. I'm not a forensic accountant, but just looking at that claim, to me, it's an orange flag. It's not exactly a red flag. Then they say that the company is trading at high valuation because it's a software mirage. And, I dismiss that one entirely, because to me, STEM is not trading at a premium valuation. In fact, it's in no way premium. In my view, compared to a total addressable market, in my view, that company is cheap. And in my spreadsheet, I show that company is pretty cheap per my spreadsheet and my standard way to analyze company. Analysts are pushing very hard on the low software sales. They keep dinging the company for software sales. It's not a mirage. Every investor knows that the software sales are not as high as they claim. Well, they're not even claiming, but everybody knows that the software sales are not that good right now. So no, to me, saying it's a mirage, no, it's not a mirage. They've been very open. If you listen to the conference call, they've been very open about this. And when they play on word, like they call it, oh, it's not software, it's service. Well, is software a service, right? Software sometimes could be a service. It could be a software as a service. So to me, it's kind of playing on words, But regardless, that argument that the company trades at a premium valuation, I think is moot. The company does not trade at a premium valuation. Okay, number 3, STEM overpaid for also energy. And from what I look, yeah, it's true they paid quite a bit of money. And what I'm going to do is I'm going to give it an orange flag. But I think most people who are not me may want to give this a red flag. Many companies did a lot of awful acquisitions in 2021. And so I don't doubt that STEM overpaid. And I'm willing, I'm usually very negative when on acquisitions in general and when companies overpay. But just because to me that acquisition was done at the heart of energy revolution, right? It's a solar company, also energy. It's a solar software because it's that such as the heart of a megatrend, and a megatrend that's growing so fast. To me, it's just an orange flag, not a red flag per se, because yes, they overpaid, but look at the field, look at the total addressable market that company is in. So that's just to me. But if you let's say you're neutral on energy revolution, you're neutral on Tesla, neutral on solar, neutral on Enphase, and you see this happen, that should rightfully be a red flag for you. Me, I'm definitely not neutral on solar and batteries and Tesla and renewable energy. I'm very bullish on it. So that's why I'm willing to give it an orange flag. Okay, when they criticize Gap, to me this is green. Who invests based on bookings and backlogs? Like we all know bookings can be canceled. That's a common thing, right? Bookings is a non-GAAP metric. Yeah, it's a common thing. Like, yes, sure. I mean, if you, I don't know, a silly example, you're gonna book a hotel, a vacation for 3 months from now. If you change your mind, you're going to cancel, right? Even if there's a small fee. I mean, it's very obvious to me. Dinging them on bookings is silly to me. I would also argue that anybody who's a gap enthusiast, like if you're going to be a gap metric enthusiast, you could criticize just about any company, right? And miss out on great returns because gap has not kept up with the nature of business and with the nature of technology, in my opinion. The best example that I have for that is like, look at how long it took for a company like Tesla to get into the S&P 500. Look at how long it took. Right? Look at all the returns you missed. So gap versus non-gap. Again, I'm not. I don't like gap. I don't like gap at all. And I prefer companies to tell me economically relevant metrics that are relevant to the business model itself and how they view the business model, not how generally accepted accounting principles see how business should be done. That's just my view. I realize I'm on my own on this, but that's okay. The cash burn is an orange flag. I always look at cash burn. I know there's cash burn for this company, but so does everyone, right? Every growth investor is going to look at cash burn. So many companies have negative cash burn. Like that's the way it is. And the insider that could be an orange flag. The insider selling that they point out, to me it's fine. I went back into the insider selling. Like the CEO last sold on May 9, 2022. So that's really, that's not at the peak, right? The CEO didn't sell in September at the peak. Insiders sell for many different reasons. And I'm consistent here. Like whenever you bring up in the comments, many of you have brought up in the comments, oh, they're selling stock. Like to me, there's so many different reasons why you could sell. So many sales are automatic. You don't know what's happening. Maybe you gotta pay for the kids' private school, or maybe you gotta pay for I don't know, a home improvement. There's so many reasons why CEOs sell. So that doesn't scare me at all. This is just my take on the short report. All right, now moving on to the full financial analysis. So I'm going to try to be, again, as objective as I can. Revenue growth, the higher end of the revenue growth, I'm giving them the higher end, and how I calculate this is very good. It's excellent. 79% year-over-year guide for the higher end. Yeah, you're going to be in the 60% if you take the lower end of the guide. So that's excellent. Excellent guide. The competition. They have, I believe it's called Confluent or Confluence. Don't quote me on that. I think it's Confluent. They have Confluent as competition. That's a stock that I need to study. I haven't studied it yet, but I know it's decent competition. And they also have, the elephant in the room, Tesla, the competitor in that field for so many different sectors, right? Whether you're talking about Enphase and the Enphase IQ battery and the Powerwall, or you're talking about electric cars, or you're talking about now megapacks, yeah, Tesla is going to be your competitor. I will say about competition, and I'm sure there's a few more small competitors, but I will say is that the space is so large. The space is so big. And actually, you look at STEM, they serve, compared to what they're putting as their total addressable market, they're only serving 0.09%. So not even 0.1%, not even 1/1000th. So yes, I think that space is so huge that there's space for different players. Macro sensitivity, in my view, is low. This is a money-saving product. This is a product that saves money for its consumers. These are on the contrary, when you have a crisis, these are easy sales because you save money by buying the product. The growth by acquisition, that's not good. I did not like that they had one acquisition. Could have been worse. They could have had many acquisitions, but that's not good. The SG&A as a share of revenue, I like to see that trending down, and it is trending down compared to revenue. So that is good, right? They're working towards actual profitability, even though that's really not something I look at too much. They're working forward at least a positive free cash flow by reducing SG&A. So that is good, and I like to see that. It's still growing, but it's growing at a slower pace than revenue, which is what you want to see. Any near-term bankruptcy risks? Okay, my calculations show a minus 25 million negative cash flow over the past 12 months. Their debt was 542 billion and total cash is 250 million, so they have a negative cash position. They have a net cash position of minus 292 million. Now keep in mind, $500 million in debt. And so theoretically, with a 250 million in cash and 25 million negative cash flow, they have a theoretical 10-year runway. That's theoretical what they have, but you would have to look into the debt and see whether they're going to have an easy time or not at rolling over that debt, right? You would have to look into the maturities of that debt and see when does the debt mature, when do they have to pay it off, are they going to be able to go out and issue more debt? Are they going to be okay with the new interest rates? We've had a major change in the debt interest rate environment right now. So again, right now for me, I guess this is an orange flag again, but I didn't dig into the maturities because that's a stock that's gonna go on my too hard pile. So that's why I didn't dig into the maturities. If I was actually interested in buying STEM, you should look at the maturities and see when that matures. Gross profit margin. So I give them the upper range of their bound. I was generous with them, 20% next year in the best case scenario. So our best case scenario for next year is 20%, which in my view is extremely low. I mean, it's just so low. Like, yeah, it's just low. It's just low. The debt. Okay, so if you look at the debt on a trailing 12-month basis compared to their revenue, that's pretty high. If you give them credit for how much they're going to grow revenue, that's medium. So they have debt. I would rank it as high right now if you look backwards. I would rank it as medium if you look forward. But the debt is there, and so there's a lot of companies out there that have zero debt. So investing is an opportunity, right? It's all about opportunity cost. Like if you put money into STEM, you're not going to be putting money into another stock that say has no debt. For dilution, the dilution has been fine in my view. As far as insider ownership, well, I really don't like that. I don't think it's that good. They only have 5% insider ownership, and the business is actually not founder-led. The business has been led with, I guess, the next best thing to a founder, which would be the CEO has been there since 2013. He's been with the company since 2013. So I guess that's the next best thing, almost, exactly 10 years, actually. 10 years there is the next best thing, but it's not founder-led. So many businesses that you can buy right now are founder-led, so it's not founder-led. But also the insider ownership is very, very low. And when you look, the share of stock that the CEO has is all about stock awards and stock grants, right? So again, not as high as I would like it to be. For such a risky company, you would want that to be higher, in my view. Revenue per employee is absolutely excellent. But again, see what they sell, right? They sell expensive battery systems, so that probably explain it. But that's nonetheless excellent revenue per employee here. And let me conclude by showing you my spreadsheet. So as you can see, and I've been putting it into my spreadsheet of Energy Revolution stocks. Since I'm not selecting the stock, I'm probably going to be removing it from my spreadsheet. But even by giving them the best credit on their guidance, if I just look at the numbers, this company right now is dirt cheap. It's a dirt cheap company, but I would say that it is too hard for me to give it my seal of approval. In my view, for my own portfolio, this is just about me and what I do, right? But in my view, it's just too hard of a company, because we don't know the extent to which the Tesla software is winning. The Tesla software is so tiny, right? Autobidder is so tiny within Tesla, and the software set is so tiny that they don't report on it. So we don't know how well they're doing. Right, and I think one of the main reasons why you would invest in STEM is because you want to invest in that Athena software, and so it's tough for me when I look at the elephant in the room. It's tough for me to assess the success of STEM. I'm not an insider to that industry, and also the 20% best case scenario gross margin. I mean, it's so tiny, so tiny. I would wonder whether this company is fully optimized for gross margin, and if it's not, I typically don't invest in stocks that are fully optimized for gross margin. So this is I guess if I was an analyst, I would say this is not a sell, this is not a buy, this is a neutral. But for me, this is too hard. This is much too hard for me. The stock has been divided by 8 from its peak. You had the IRA, which led to a bounce in the stock. But now that the market is not as excited about IRA, the stock went back down. And again, I think there's a lot of risk, especially this company has debt, right? Not founder-led. There's a lot of risk. They've been caught in that macro storm. They've been sold with every other SPAC. They have a high short ratios and a short seller after them. If gross margin was 40%, I think I would be in. If gross margin was 40%, gross margin is really the bummer for me for this company, and I don't have enough industry knowledge of their software, like I said, and I made a full video about the software, trying to wonder, how good the software is. So not a yes for me, not a no for me, a too hard. Following Warren Buffett's too hard pile. This is just too hard for me. But I loved researching this company. When I first found out about it, I was so excited about it. And then when you have to make a decision, you realize it's just I have to be disciplined. And there's so many great stocks out there. So, anyways, not investment advice, of course, just entertainment. Thank you for watching. Please like and subscribe. Have a wonderful day.